Good morning, everybody. It's still morning for 4 more minutes, and we're ready to convene our meeting. Are there any public comments?
No, Mr. Chair, no public speakers.
Okay, so the first order of business, please, is the approval of the minutes of the January 26th Finance Committee meeting. May I please have a motion? Second. And a vote, please. Aye. Minutes are approved. Let's see. Gary, would you take us through the work plan, please?
There are no changes to the work plan. The next is Mr. Johnson will bring us through the budget watch this month.
Good morning. I'm going to talk about 2008 results and then January flash results. We'll start with 2008. The report to the Finance Committee, which you have with you, includes the first close of the agency's 2008 results. I just want you to keep in mind that it's likely that many of these figures will change with the final audit of the results that will be reported in April. The results when compared with the final estimate. Passenger and toll revenues were very close to forecast. Expenses were $71 million favorable, mainly due to lower non-labor costs, specifically energy, claims, maintenance contracts, and other business expenses. Some of this underspending may be the result of timing, and we'll be looking at that in the next month. Unfortunately, subsidies were $110 million unfavorable as a result of reduced real estate-related taxes and timing variances. I'm also going to talk about the results against the 2008 budget. Farebox revenue was $80 million, or 2% favorable, and that was due to higher ridership. Toll revenue was $28 million, or 2% unfavorable. A lot of that may have been done due to higher fuel prices in the first half of the year. Expenses were $66 million favorable. However, $75 million of that variance was due to the fact that the budget included the general reserve. In reality, we were virtually on target with the 2008 budget. Subsidies were $408 million unfavorable, primarily due to lower real estate-related taxes. Any questions about results versus 2008? All right, I'll talk about January flash then. January passenger revenues were slightly worse than budget due to lower ridership. That was $4 million, or 1.3%. Toll revenue was on target. Expenses were on target. Debt service costs were slightly favorable, $3 million. I think the story again with January are that real estate taxes continued to struggle in February. Total real estate receipts were $37 million, or 50% below budget. MRT taxes were $12 million, or 37% lower than budget. And urban taxes were $25 million, or 60% lower than budget. Through February year-to-date, real estate-related taxes are $75 million, or 51% lower than budget. And that's all I have.
Okay. There will be comments by our Chief Financial Officer in a little while, so I guess we should go on to the next item.
The next item is Finance Watch. Mr. McCoy will bring us through that.
Okay. This month we have an expanded Finance Watch that was in your packets. It's a stapled set of pages. We'll begin with the first page, which is a summary of our market activity up to date. This past month, we issued $475 million of TBTA 2009 Series A bonds. It was done in 2 parts, as I discussed last month. A fixed component as well as a mandatory tender bond component. We separated them by 15 days due to the fact that we had put in a refunding on the fixed rate bonds. So as you can see here, on the fixed rate side, we issued $325 million on January 27th. We upsized from where we had planned to be. We planned to be at $250 million, and we had a very strong experience in the market, both on the retail order period as well as institutional pricing. We made the decision at that time to increase the amount, and by targeting those TBTA 2005 B1 bonds, which have a DEFA bank facility on there, those bonds have been put to the bank. The bank facility had gone to a term out situation, which meant the principal amortization was accelerating. So we thought the right thing to do there was to just take those bonds out altogether, which we have done now. The A1 bonds, initially we were planning about $100 million. That came on February 11th, and this had a mandatory tender date of January 20th, 2010. And you can see here our final interest rate on those bonds was 0.65%. We feel that's a very attractive cost of funds, saving us approximately $4 million in 2009 as compared to had we issued fixed-rate bonds. So you see down at the bottom the combined TIC for both series was a 5.35%, comparing very favorably to our budget of 5.88%. Again, we talked about how we're going to use the proceeds on the fixed rate side for that particular refunding component. We're also going to do a refunding, a partial refunding of the TBTA subordinate 2000 CD. Those bonds are in variable rate mode, $175 million outstanding. We're undergoing a negotiation right now with the bank facility there, which is Lloyd's Bank. We're eliminating the FSA insurance. The facility that we're negotiating with Lloyd's comes at a fairly high cost, so we made the decision to lower the amount that's going to be outstanding and save a little money on that. And so we're just taking those down by $50 million. Any questions on this?
I have several questions, Pat. The first one is, what's happening to the swaps that are associated with both of those variable rates that you're taking out?
Sure. On the TBTA 2005 B1 bonds, those bonds are going to be moved, those swaps, I should say, are going to be moved to the to the TBTA 2005 A's, and a portion will be also moved over to the TBTA 2002 F's, I believe it is. The basis swap that's on top of those will be terminated, and that's about at a zero cost to a slight benefit to us. On the 2000 and CD bonds, the small portion of that notional swap will also be moved over to, I believe, again, it's the 2002 F's.
Second question, I want to ask about financing costs. The gross spread or the cost of issuance or financing costs on the $325 million issue was $13.79, or $4,482,256. Of that $13.79, $5.14 was compensation to the syndicate. What was the rest of that?
Just a moment. Well, the state, the state bond issuance charge is always our biggest cost component. That was $3.3 million. There's the financial advisor fee, $308,000, bond counsel fee, $125,000, printing, $15,000, trustee, $15,000. There's the rating agency fees. Moody's was $90,000, S&P was $40,000, Fitch was $50,000. Our auditors charge us $25,000, and then we have the URS, the independent engineer report, which is they bring down their report and update it. That was $75,000. So I think that gets you to the number.
And similarly, on the variable, on the put deal, the mandatory put deal, $9.96 spread, of which $1.40 was compensation to the syndicate. Is it a similar type of situation where it's
Right,
state
right.
bonding?
Yeah, well, the numbers I just gave you were the combined for both pieces of the transaction.
And did you look, 0.65 is a wonderful rate for a year. The question is what happens next year. And by my calculations, if rates next year are 20 basis points higher than they were on February 11th of this year, this would not have been the best strategy.
Actually, it's higher than that. It's about 45 basis points.
Will you share that analysis with me, because I get a very different result when I run it?
Sure.
Doreen, were you saying which rates in at the end of this year? Oh, sorry, Doreen. You said if rates were up 25 basis points.
Well, on February 11th,
Right.
when these bonds were priced, the long end of the municipal market had rallied very, very substantially. It was better by about 30 basis points than when we had issued the first set of bonds at the end of January. And our cost of funds probably would have been closer to a 5% level if you had taken the spread that we experienced on January 27th and applied that spread to MMD on the 11th.
Right.
Now, of course, it's not completely apples to apples, but it's a pretty good surrogate. And I was just curious as to whether we felt compelled to move ahead with the mandatory structure, which of course means that that next year we will have to issue fees to refinance these bonds once again, which are not insubstantial. And rates had come down 30 basis points. So I was curious as to the reasoning behind moving ahead with that structure, if it had anything to do with the variable rate debt or...
Well, I think, as you know, we've been, despite the problems in the variable rate market and the volatility that we've seen over the past year, that portfolio has continued to be very attractive to us. We cannot issue new money in the variable rate markets now. This issuing the mandatory tender bond gives us an opportunity to capture the short-term market experience without having liquidity and so forth. So I think the rationale is that it does deliver savings in the current year. We believe that we can, there's really a two-prong approach we can take to when the tender comes due. We can certainly fix out if the market's attractive that way, or alternatively we can take a look at that tender. Maybe we want to extend it another 6, 8, 10 months, and do that. So I think there's more than just one answer to the question.
Well, I think the proof will be next February 11th when we see what interest rates are like, and hopefully they're not more than between 20 and 45 basis points than where they are now. I'm not sure I'd take that bet, but...
It's not a bet. It's not, again, it's taking a view of where we were this past month versus our budget, versus what other stresses are on the system, and I think that the decision is you could certainly look at it in hindsight and criticize it. I think the view is that this cost of funds. No, you disagree?
No,
You're shaking your head.
I disagree. It's
Okay.
not criticizing it after the
Okay.
fact. I think an analysis would have shown that with a fixed rate market rallying 30 basis points, it might have been interesting to have looked very, very deeply in an analysis that said move forward with a fixed rate debt, put it away, don't pay any more fees next year, and don't think about potentially kicking the can down the road. Not to second guess you or anything, but I think these are the types of analyses that it would be helpful to share.
Wait, Patrick.
Sure.
There's an assumption here that you don't go, I think there's an assumption that you, meaning the MTA and Goldman Sachs and whoever's involved in this thing, doesn't go through these analysis, but I'm sure that when you're doing this and laying this out, and Gary, you might want to comment, I think I don't want to give anybody the wrong impression here. I'm sure there's a very detailed analysis
Could I
how
ask
we do.
Could I ask a question, which is, what rate is your variable rate trading at the moment? Generally,
All over the place.
It's a little bit all over the place on a Triborough letter.
There's a rate report in the, every
I'm sorry.
issuance rate report is inside the document.
On the Triborough, a good letter of credit bond is in a weekly mode is trading at 0.5%.
thank you.
Okay.
The only thing I wanted to add to, not really to the iterative part of the discussion, but about the iterative part of the decision making. We originally talked about looking at a mandatory tender about, actually about a year ago, and then we shelved it for a while, and then came back to the discussion in advance of this deal. And part of it was really not directly related to the plan of finance about this particular issue, but really rather, taking a look at a place that we hadn't been. MTA, and mainly it's the basis risk. It's the apprehension about basis risk. And so when we went in this time, we made, sort of started from the top line about the judgment about how much do we need for Triborough because we wanted this to be the Triborough issuance for new money, as well as the piece that we wanted to take out, which I think everybody understands what was behind those two pieces. And then the last piece was whether or not we chose here to do to take a look at this mandatory tender structure. Interestingly enough, the market reacted very positively to it. There was over $1 billion in interest for something that was sized at the time at $100 million. I don't think this will ever be a substantial staple of the product that we're in. But I think, looking at some new things is not a terrible idea, particularly if we're cautious and modest about how much we bite on these kinds of pieces. And that's what I found most compelling about the decision-making part of the process, was that this was an area that we hadn't been in, and it gave us a little bit of a different look. And it was I would say a relatively, I mean, the number sounds big in the abstract, but in the scheme of the $24 billion portfolio, it's a relatively small toe in the water. And so, I think that Commissioner Frasca, your point about how it exposes us to a different kind of risk, I think that's unquestionably true. It is a different, it's a different kind of an exposure, one that's different because we haven't gone this way in the past, so it's a different exposure than what we've talked about. We obviously have substantial exposure to fluctuations in the market. Here we have a different kind of exposure, and I don't want to minimize it. We have a different kind of exposure because we now have a refinancing exposure, which is new. But again, I think we were relatively modest, and our intention was to take a look at this slice and see how it reacted. It was interesting. The market receptivity to it, as I said, was very surprising to me. But mainly, I think because the timing was propitious because so much money was flowing into these funds at this particular moment, which kept the price down. As you saw, the price was at 65 basis points, which was very low. So that said, at least, I don't know if that's helpful or not helpful, but that's at least, where the thinking was behind the structure.
Absolutely. I commend you for doing new things. I just feel that given the turmoil in this market and what lay ahead of us over the next 18 months, with a rally on the long end of the market, I would have loved to have seen us lock in a price that potentially could even have been through 5% and saved this concept perhaps for another credit at a time when the long end of the market, as it no doubt will, was back up again.
I mean, we drink from this hose, nearly incessantly. I wish we drank from it less. And Pat will be going through our next sip. So, the structure of this, I think, really was about, I hope at least the way I was describing it, will be, as you know, because we've been now, compared to the I guess over the last 3.5, 4 years, obviously now we've been, well, this is an exception, but very much on the fixed long-term side of the equation. And as you know, our entire portfolio, the face of that portfolio has now dramatically changed, right? So it's now much heavier towards long-term fixed than it has been in anybody who's on this board's now experience. And I think over the, probably over the immediate term, that's probably going to stay true. Although who knows, right? Maybe the new Wall Street will have yet new ideas, but in any event, I think it's likely to be true. And as we continue to go through the financing plan for the remainder of this year for that which we're authorized, I suspect it will be even more true, I think.
You want to go ahead?
Sure. Okay. Are there any other questions or comments on the TBTA transaction? Okay. In your packet, I would draw your attention to the next 2 pages, which are also in the Finance Committee book, but we wanted to pull them out and just to draw your attention on debt service. Page behind the cover there is December 2008 year to date, and you see the variance of 0.9% on a $1.529 billion budget. Page 2 gives you another view, which is forecast versus preliminary actuals. First page is adopted versus preliminary actuals. And again, here you see the variance come into 0.7%, or just under $11 million variance on the whole portfolio. And you see the rationale, the reasons why on the right column that explain why we're seeing variances. Oftentimes, you'll see the timing variance appear as a description for why we're seeing differences, and that has to do with a mismatch between when deposits are actually made versus when the payments are made to the bondholder. There's a difference there. If you turn the page again, you see January 2009 year-to-date, and again, this is looking at the February financial plan, the adopted budget condition to the actual results, and you see a 2.4% variance, or $2.9 million for the month. And again, it's a timing difference there. Over the course of the year, those sorts of differences tend to even out. The next page is a new page to the committee. I want to draw your attention to this. This is the beginning of our reporting on our variable rate portfolio. And what you see here is every single transaction that's in the weekly mode, and it gives you a fair amount of information. The series of bonds, if you look at the upper left corner, TRB, that's Transportation Revenue Bond, 2002 D1, tells you who's remarketing the bonds, JP Morgan, the liquidity provider, West LB or West Landesbank. The liquidity, if there's an insurer there, and here we do have FSA insurance on there, par outstanding is $200 million. There is no swap. And then you see the last about six resets of the bonds. This particular series has not traded well. 2.75% is 2.2% over SIFMA. SIFMA is the Securities Industry Financial Markets Association. It's their 7-day high-grade index. We like to be at or inside of that index. And as you look at some of the other transactions, particularly those that have a letter of credit as opposed to a standby, SBPA, you'll see that those have done very well. And I would, I guess, look at, if you look at the second block, the dedicated tax fund block, DTF 2008 B1, Barclays is the remarketing agent, and the liquidity provider here is Bank of Nova Scotia. This is a letter of credit for $100 million. You see our last reset was 0.25%, which was 30 basis points better than SIFMA. All in all, that's where we would like to be, and that's where we've spent a lot of time, particularly in the fourth quarter of 2008, restructuring the portfolio to eliminate those bonds that had insurance on them, particularly AMBAC insurance, and substitute a full letter of credit for a standby bond purchase agreement. As I said, we're still working on one of those. It's the lower right transaction on your page, the TBTA subordinate 2000 CD bonds with a Lloyd's Bank, standby, and FSA insurance. We're negotiating with Lloyd's to substitute a full direct pay letter of credit for the standby, and then we would terminate the FSA insurance. We're looking at that transaction right now. If you turn the page, you see we have 3 series of bonds in daily reset mode. This is an interest rate that resets every day, and you can see here we're doing pretty well as well on the daily bonds. Obviously, we're much more weighted on the weeklies. The daily bonds are mechanically somewhat tricky for the remarketing agents and the investors. However, we have found that the instant liquidity, the daily liquidity provided by these bonds is attractive in volatile markets. So again, we're on this part of the portfolio, we're through SIFMA. Lastly, you see that we still have some auction rate exposure, both in weekly as well as 28 and 35-day auctions. This adds up to, I want to say, about $800 million in auctions. In 2008, we refunded over just under $2 billion in auctions. So we've taken a lot of them out. This is what's left on the portfolio. These auctions across the Transportation Revenue Credit, the DTF credit, as well as 2 Broadway COPs. COP stands for Certificate of Participation. because of the fact that the maximum fail rate on the bonds is a % of LIBOR, you can see that they've, fortunately, because LIBOR is very low right now, they've reset at very low rates. I think this is, at the moment, a situation that we can live with. Lastly, sir. Well, live with because there is not readily available liquidity to replace, to stand in for the auction. So that means typically a fixed rate refunding of the bonds. And as you can see where the rates are, you know, if you look at that TRB 2002-B1, you know, the last reset was a 0.67%. In order to get rid of that, you'd have to, at least in the current market, you'd have to issue a fixed rate bond to refinance that at, you know, 5.5%, depending on the kind of the day of the market you go into.
The point of living with it has to do with the, as you know from the discussions that we had all through the second half of last year, where we took out an enormous amount of this part of the portfolio, all had to do with where we thought the risk was with respect to where that auction rate was going to, where it was going to perform.
What you really need to do, it's hard to take a piece out of the portfolio. You really need to take a look at, this is $800 million on $27 billion. I mean, I think that's what's really important here. As, each one of these different class of debt, what percentage is it to the total? Isn't that really one of the key things that you have to look at when you look at this thing?
In the report, actually, in the variable rate report that Pat leads the board through twice a year or once a year, whenever it is, he actually goes through the allocation. But just with respect to the chairman's point about the decision making to take some out and leave some in, it has to do with what that performance is. There is risk associated with these, depending on what happens with LIBOR over time, and there's unquestionably risk. And also, this is not from an investor standpoint. Investors do not love being stuck in these, you know, not just our investors, all investors that remain.
Who's holding these bonds?
From the best we can
Some
tell,
are banks.
Mostly at the broker dealers. In our case, it's largely J.P. Morgan, Citi, and UBS.
Largely.
Yes. I think very few investors are actually still holding the bonds.
In addition to LIBOR, I think we just have to realize that the trading value of these bonds is directly tied to the bank's credit ratings. So as the fortunes of these banks move up and down, that will be reflected in the trading as well. Right now, I think we just have a couple of weak kids in camp here, and hopefully they'll get stronger. No, I'm talking about the banks themselves in terms of their credit posture.
The broker dealers.
No, the letter of credit or the line of credit
All right, I thought you were
providers. So that it's going to change as they get better, hopefully, and not weaker. Hopefully.
Yeah, there you go. That's news right there.
Sorry, the last page is just a somewhat small print, but what you see here is a transaction by transaction summary of our entire portfolio. When the bonds were sold, the principal amount that was issued, and the amount outstanding. As you know, we do pay down principal on an annual basis, and so you'll see the amount outstanding go down. If you go over to the rightmost columns, you see the final maturity of the bonds and then the all-in true interest cost at the time of issuance. In the case of a variable rate transaction, you'll see a footnote that points to the back page that explains that for those variable rate bonds, those are the average rates to date that we've paid, knowing that in the future they'll go up and down. And you see the weighted average interest cost for each credit summarized at the end of each credit there. So, for example, our transportation revenue, our weighted average cost of funds is 5.25%. The last thing I wanted to post the committee on is that we're preparing our next issuance of bonds, and this is a dedicated tax fund borrowing that will occur next month. This was on the schedule that you saw last month and that you approved with the supplemental resolutions. This will be the DTF 2009 Series A, about $255 million. We're going to issue level debt service bonds throughout the yield curve. Hawkins, Delafield, and Wood as bond counsel. Book running senior manager is City, and that's just a rotational assignment for them. And as co-senior manager, Siebert Branford Schenk is going to be serving in that role. And again, that's consistent with the governor's executive order 10 and the results of the commission on MWMBE firm participation in underwritings. And we're scheduled to close on March 11th.
Fixed rate.
This is going to be fixed rate issuance.
Patrick, the one thing I understand, and correct me if I'm wrong, March is a difficult time for an issuer because there's a lot of issuance in March and April. Do we take into account when we issue to do a little bit less at that time, since we really have a schedule for a whole year?
Right. Well, when we developed the schedule, we took that into consideration, and that's why we put this transaction where we did. Comparing to some of our other issuances, which might be 300, 400, 500 million, this is on the smallish side. And we recognize that, leading up to tax time, sometimes March can be a little difficult. But we are in somewhat uncharted territory with the market, and it seems to be a week-by-week changing environment.
Pat, are you planning on, Mark, I'm sorry, go ahead.
Sir.
Are you planning on continuing to distribute these enhanced pages in future months?
Yes, this will be the Finance Watch going forward. All these pages, you can see the whole portfolio here, all the costs. I think I view it as a work in progress, and to the extent that members want to add more information, we're happy to look at what else you would like to see. I think there's a lot here to digest, and if anybody has any questions offline, I'd welcome those questions.
I agree with that.
Okay, thank you.
Mark, did you want to say something?
Yeah, I have a question. So if you go back to page 7,
Sure.
your all-in true interest costs, your last column on the right there,
Right.
just to make sure I understand this. In the variable rate scenario, where we keep kicking the can down the road, those interests as a percentage would increase every year. Is that correct?
Not necessarily, no. It depends on, where those bonds reset on a daily or weekly basis, as the case may be.
Well, let's talk about the case that Commissioner Frashka talked about, and February 11th to February 11th. So if we find ourselves at February 11th next year and we have to re-up them, we can't convert them, or it's not favorable, as she pointed out, those costs are incurred again, yes?
Well, as I said, there's a
The financing costs are incurred again.
There's a two-pronged approach that we have with respect to the mandatory tender bonds. One is that we can fix them out, and as I said, we view the break-even as about a 40 basis point increase in rates from where we were last month, this last month at the end of January when we issued the fixed-rate bonds, versus the possibility of taking that tender and paying it off with the proceeds of a new tender. So there is additional costs, but you're doing it at a rate level that continues to be very attractive, assuming your short market continues to deliver the 0.65% type rate that you want to see. Mr. Page.
I think it's worth noting in here that although there have certainly been problems in the short-term, in some structures in the short-term markets, and problems with the ratings of bond insurers and various banks, the fact of the matter is that the sort of healthy parts of the variable rate market at the moment are trading at sort of in the neighborhood of 0.5%. And that appears to be reasonably securely true at the moment, famous last words. That debt has also found a market through periods in this market when investors weren't willing to take long-term bonds at fixed rates. And it's in the long term, it has been a part of this agency's debt and certainly other public issuers' debt that has saved us cumulatively a very significant amount of money as compared to the long-term cost of financing fixed rate. This tender option structure that we're talking about is, in essence, a way of accessing the short-term market. It's different, but that is, in effect, what it's doing. I mean, which is, I don't think that's a definitive answer as to whether it's good, bad, or indifferent, but it is down that particular alley that is a subject that, I mean, we certainly can't ignore. I mean, in the scheme of things, short-term debt has been and continues to be an attractive cost of money vehicle if you can make it work.
Yes, thank you.
Just a quick question. The all-in true interest number,
Yes.
does that include, in fact, the cost of bond counsel and investment houses and everything? That's everything is in there.
That's right.
Okay.
On that note,
Yeah, sure.
quick question. Everyone keeps talking about the fees and the costs like that. You had said that the single largest one is the state bond issuance charge. Did they actually do anything to get that charge? What do they do for that service?
They passed a law to get it.
My point exactly.
Right. The state bond charge is for the rest of the committee. This is a fee that's imposed by the state. Bond charge that equating to $7.50 per 1,000 bonds issued. So it does represent a significant cost. It depends on how much you issue. I don't have last year's amount, and I don't want to throw out a number, but it's, it can be a significant number, All right.
I think we have different aspirations.
That's
in terms
not
of
what the state
legislature
has in
this year
mind.
than that.
You issue $2.5 billion worth of debt a year, and what's the percentage on it?
Well, it's $750 per bond. Last year was an unusual year because you even for not only for new money but also for refunding, you've got to pay the state bond charge. And so last year was a pretty heavy year.
$2 billion worth of bonds, it must be $15 million bucks.
Right.
Right.
Well,
$15 million
yeah.
bucks.
We're like other.
So we should apply for a rebate on mass transit.
The state taketh and they give it away.
That's
So
right.
just a round
That's
circle.
Exactly right. Okay, Pat, are you?
That concludes Finance Watch. If there's any other questions, I'm happy to.
Anybody have anything else before we let them go? Dismissed.
Thank you, sir.
Thank you.
Okay, thank you.
Okay, I think Gary wants to. Gary,
Now we
are
have
you-
the CFO remarks.
Yeah, the CFO remarks, Gary, do you want to
Yeah.
take us through that, please?
This will be substantially faster than Pat's report. You should have handed out to you a document with 3 colors. Let me explain what it is that we're talking about, why it is that we're talking about. At the committee really since the spring of 2007, we have been periodically, as in almost every month, but periodically talking about our principal vulnerabilities, and we've described that in terms of what risk it presents to the financial plan. And twice before, we've talked to you about stress testing. Now, let me first of all draw a distinction between what you read in the newspapers about what's happening with the Fed stress testing banks, which is very different than what it is that we're going to talk about. In the context that we're talking about, this is really about applying, in essence, ranges against some important assumptions that have to do with at the end of the day, the deficit that you collectively are obligated to close one way or another. It is not applying extensive modeling in the event that the economy gets much, much worse than what it is that's currently forecast. So I want to make that point first, and then let me just describe, I guess, a couple of things to place it in a little bit of context. One is that, interestingly enough, when the Philadelphia Fed, which does this quarterly report survey of forecasters, and they report on it, the one that they just did 10 days ago was fairly sobering in that the percentage of forecasters that the Fed surveys that forecast a contraction for all of 2009, and this was after they explicitly asked the forecasters to take into account the impact of the stimulus bill, which at that point had not been enacted, but the size and scope of it was generally taken into account. The preceding survey, which was 3 months earlier, had yielded that something about 55% of all of the forecasters forecast a downturn for all of 2009, and incredibly, with the stimulus plan, the number of forecasters who were projecting a downturn for all of 2009 went from 50-some% to 90%. So the point is, in the context that we're describing it, as you think about where we were when we considered and adopted the budget in December that was produced in November, the situation obviously has not, the general economic situation has not gotten brighter. There have been changes, but it hasn't, generally speaking, gotten brighter. And generally speaking, forecasters have become more pessimistic rather than less over the last several months. It's probably worth noting, for example, at the Governor's Council, the Council of Governors in Washington over the weekend, very sobering information came out about different states projecting changes in the neighborhood of 15, 18, 20% changes just since, again, the same time period, November and December, to what they're forecasting in terms of stress on their operating budgets. So in any event, the point of the exercise now is to sort of talk about three particular elements that most impact the revenue side of our budget. And we're going to talk just briefly about the real estate transaction taxes, which we've talked about, I would say, ad nauseum, the effect that employment changes have on our fare and toll revenues, and then state tax receipts. In the first set of boxes is the gross numbers that we anticipate are in the adopted, the budget that you adopted for this year. Understanding, of course, that in order to balance this year's budget, you have a 23% increase in yield, you have the additional actions for budget balance and all of the other actions that were all part of that. Nonetheless, this gives you a quick sense of what those forecast receipts would be. So let's talk first about real estate transaction taxes. And again, let me just place it in context again. I know we've done this over and over again, but it's worth doing again. As you can see on the top line, we forecast for the year that we are in, 2009, receipt of $880 million in total for real estate transaction taxes. The context of that is as follows. 2007, which was the high water mark for all of the taxes, we received from this tax base $1,587 million. So the 2009 budget from 2007 reflects that much of a drop. Last year, our actual receipts in 2008 were $942 million. So there was a more than 40% drop from 7 to 8, and then we forecast an additional drop from 8 to 9. And the amount that we forecast to receive was $880 million. Now, you've heard us through now the last 3 months in a row. In the budget watch, we've talked about what the monthly forecast will be. There's one really interesting aspect of the proceeds for the last 3 months, and that is that they haven't been volatile. They've been horrible, but they haven't been volatile. Sounds like a Woody Allen movie, right? But, and they have been almost the same in the $34, $35, $36, $37 million range now for December, January, and February, which probably means a couple of things. It is probably an expression of what this tax base against this region, against this marketplace looks like, fundamentally in the absence of any reasonable functioning financial institutions and commercial lending. I think that's actually what you're seeing is a strange expression of what, and I hope this is true, of what the actual bottom looks like in this at least one set of segments. I say that just by way of saying that when you're looking at a year-over-year reduction of 70%, which is what these numbers actually are, year-over-year, 70% reduction, what we've seen now in 3 consecutive months. it is probably hard to believe, and I do not believe, that that's a functioning market, and that that will be something that we would see over any significant time period. If you recall, when we first began to really talk about this in detail, we described this marketplace in terms of what happened in 1987 when the real estate market retrenched dramatically. And we walked the committee through sort of how similarly the increase in the tax proceeds over the past couple of years earlier, 2002, 3, 4, 5, and 6, looked as the run-up in the mid-'80s looked, and then we graphed what that looked like on the downside. And actually, it predicted, not unsurprising, I guess, it predicted last year, the end of 2007 and 2008 fairly accurately. It did not predict what's happening right now, this $35, $36, $37 million a month level of proceeds. That is that's probably more related to the condition of the financial institutions than it is to the condition of the underneath part of the real estate market and the combination of what that has on just lending in general, but particularly on the commercial side in New York City. What it also doesn't reflect is, and this is not to say this is a positive, because in the scheme of things it's a negative, but it doesn't reflect distress. We're not seeing distress sales come through the pipeline, and I'm not going to try to characterize why that is or what significance it has, only to say note the absence of it. So all of that said, that gives you some sense of the context of real estate, which then gets you to, if you look in the center box, the yellow box, which we characterize that deeper, faster as a way, just a stand-in for what's generally been described of how general economic conditions that the downturn has been substantially deeper and it's been occurring much faster than what had been predicted. And so we use that terminology only as a way of describing that. Basically, though, what we've done is we've taken, using that label, what we think to be fair, not unfair, but fair estimates of what bottoms look like. And so with respect to that, the real estate transaction tax receipts, where you see a decline of an additional, the parenthesis obviously means a decline of 446. So what's that off of? That's 446 off of the 880. What does it reflect? It reflects if there were an entire year, if the entire year were similar to what we have seen so far. So again, the monthly receipts have not been volatile. If for some reason they stayed at that level, then this is, obviously breathtaking. So we've already seen, we've seen in the case of this 2 months, so you got over $50-60 million that's already dropped out of the budget, and this is what that would look like over an entire year. The next number, which is what we expect from, and again we'll go back to the top box, which is the green box, from fares and tolls, and it's broken down into two because the financial plan projects the adopted budget rather assumes a 23% increase in yield starting in June of 2009, and that's why it's broken into two. So as you know, the 2009 budget that you adopted has a decline in fare and toll revenues, irrespective of the, unrelated to the increase, obviously, but a general decline in ridership for 2009 after years and years and years of increasing. And as you've heard in Budget Watch, we have now seen a couple of straight months now of declines in riderships, both, and that's across the commuter mode as well as subways and buses. So, that is occurring. The quote-unquote stress test that we apply in this aspect is to accelerate that much faster. And so against the general decline that the budget assumes, this in essence assumes a substantially deeper decline of another 2% actual decline from the...
Gary, in fairness, just to interrupt, I mean, if you take January, it's been very, very slight fall-off.
Yes.
Why do you feel that's been? I mean,
well, that's against budget, which already has a decline in it.
Oh, so against last year, how much is the difference, do you know?
I don't have it off the top of my head. It's actually, you have to think about it a little bit differently than that, because you had ridership increases through almost all of 2008, and then the rate of increase began to slow substantially in the summer. 6.4. Right, so against last month, it's 6.5%.
Against last year. So in other words, what you're saying is ridership revenue has declined for January. Am I saying this right? 6% from 08 to 09?
No, not month to month. That's my point. The ridership increased from January, February, March, April, May, June, July, August of 2008, right? Then it leveled off and it began to show decreases. The decrease that you're seeing in the Budget Watch, and again, in the case of Budget Watch, you're looking at revenues, but they are obviously directly associated with ridership. But you're looking at revenues. What you're seeing there is against the budget. The budget assumed that 8 to 9 went down ridership-wise by about 1% or so overall. What you're actually seeing right now is as against, and it's always dangerous to use a month over month because there's differences and all kinds of things that happen. But you're seeing a pretty significant decrease from what we were seeing by the end of last year. As much as, like I said, 6% decrease in actual ridership.
Currently now we are experiencing.
Right. And then
From last year.
From last year. Okay. In any event, if we then project an additional 2%, this is on a yearly basis, so if you actually looked at what it would look like, it would actually be a smaller decrease at the beginning and a greater decrease at the end than 2%. But again, against what the budget already shows, you then show what impact that has on the financial plan. That's $105 million against the baseline and another $18 million as against the rate of increase from the yield. On state tax receipts, the way that we stressed state tax receipts was really pretty straightforward. We simply assumed an additional 4% decline, and 4% being probably the range of the harsher range of what general economic conditions might be like in 2009 from where we thought they were in November. And so that's simply 4% of proceeds against the state taxes. The scary number, obviously, is when you add them all up. And you see the potential of an increase in the deficit of $651 million under what we've labeled as the deeper, faster scenario. And again, this is not a number, this is not a forecast, this is not a number that we think the budget is going to reflect or any of the rest of that. This is the point of this exercise, as we had promised last month, is to try to keep finance as up to speed as we can on the changing economy is going to affect us, right? It will be worse than what it was that we said in November, but we don't know how much. So this is, again, just to try to describe some ranges. And in that same light, then there's a third box, which simply is the midpoint between the base case, which is the budget, and the deeper, faster scenario, which is the middle case. So it is no more there than just taking the two numbers and dividing by two.
But in layman's terms, what you're saying is that a budget that was estimated at $1.2 billion deficit in November could possibly be anywhere from 1.5 to 1.8.5, $1.9 billion this year.
Yeah, I would be reluctant to describe it that way only because that would suggest that we are prepared to make these changes in forecast, which, number one, we're not prepared to make. Two, I do not.
When would you be prepared?
Well, we're obligated to make them in July. I suspect it'll be hard to get all the way from February to July, so I suspect we'll be reforecasting sooner than that. Obviously, we're watching this much more carefully than we have in the past.
It's an unusual time period.
I agree that the times are unusual, but that said, I think that the point is that you don't want to, particularly when you're involved, as you are, in delivering such a critical service to so many people, you don't too much want to vacillate between, pillar and post. So I think it's important to bear that in mind. But I think the other point that's important to bear in mind is that principally the real estate. You see that the biggest number where we've shown here is the real estate number. I do not believe that that collections will be that low. The economy could get much worse, and collections could get higher because the economy got worse faster, and more distressed sales actually on the commercial side of the market came through the pipeline. In addition, this part of the market has never reacted in any predictable way whatsoever, ever. Didn't react predictably on the way up, didn't react predictably on the way down. It's been impossible for us to predict slope of these lines. So simply straight lining it, I don't think is any more accurate than anything else. This, again, is just to express to you, levels of concern.
Are we supposed to be using different real estate forecasts besides the one that we're using? I know we tied, is it the city's forecast that we use?
Yeah, from a forecast standpoint, in other words, what it is that the November financial plan and adopted December budget work, it is in the main a forecast that we work out in conjunction with the city's economic forecasters. We have to make some changes to that because the tax base is different, but in the main, and we actually work pretty carefully with the city. I think that they're the fellows that work for Mark who do this, although they've been totally inaccurate. I think that they've had a very professional approach to it.
Bob, would you like to comment, please?
Now, Mr. Dardia and his team, I think, are very smart guys who do well. But it's a tough thing to anticipate. But that's the genesis of the forecasting. These aren't forecasts. What I just described for you was a very straightforward and simple arithmetic exercise of noting the fact that you now have 3 consecutive months after the credit freeze. Right? That was obviously the precipitating event. You had the credit freeze that happened in October. Subsequent months then showed this strange phenomenon of almost identical numbers.
I would just, I guess, repeat what you've been saying, that, I mean, these are real estate transaction taxes, and a lot of the problem you're seeing is that there's no financing for real estate transactions, and that continues, and it I suppose if the finance markets remain as unresponsive as they've been on into the future, I mean, this is a small part of the problem.
That's right.
Hopefully.
But a big part of our problem.
Well, at this moment, as you look at it, yeah.
Or if the banks remain unresponsive in lending, which is the other piece of it.
Well, that's what I'm talking about, basically. I mean, you need to have a credit market that works. And it's not just for real estate transactions, is for sort of the economic transactions altogether, I mean, which has something to do with our ridership and everything else that you're looking at here.
Yeah, I think it would be a mistake to think about them. They are all connected, but what you see is you see that they react differently. But they're all connected to the same stimuli, and well, yes, I am.
Yeah, you don't need to be any more depressing than you've already been.
Yeah, you want to
No.
say something?
That's enough.
Chairman, no, out. Jim?
Gary, well, these are forecast.
These
They're
are
not
not
forecast.
forecast. Right.
The question becomes, when we look in March to developing a final budget based upon what does or does not happen in Albany.
But you've adopted a final budget.
Right.
You could have a different budget, but you've adopted a final
Now, my
budget.
question becomes, do we not have to look at this at that point in time? Because I hate to think that we're gonna have a budget that's gonna maybe end up with a $650 million deficit, even after we've had these increases in either fares or tolls or taxes.
I think the whole purpose of this part of what we do at Finance every month is to share with you what it is that we're thinking about, and frequently share with you what we're worried about. And it is not, and again, I don't want to overdo this, but it is not at the moment at which I'm suggesting that, or staff is suggesting that it's time to take action. Right? We've taken a series of actions that we need to continue to take about slowing down hiring, about watching all of our administrative expenses as carefully as we possibly can. That said, I think that the point of the arithmetic exercise that we're going through is to highlight for you and sensitize to you that these are things you already know. These are very risky times. They are changing very quickly. And we need to watch them, very closely. But I think that in terms of what happens between now and March, when the board potentially would have, amongst other things, a tariff action as well as others, or perhaps a change in the adopted budget in the event that there's a ravage recommendation that's been approved. None of us can predict what is going to happen over the next 4 weeks, and I think that this is important context for for your thinking in that regard. I think it is important context for your thinking in that regard. But I would not be comfortable reforecasting at this point based on all of these numbers. Perhaps some of them, but on all of them, probably not.
I think to sum it up, to be continued, is that fair?
Yeah, well, as we have.
Okay. So let's move forward if it's okay with everybody.
Andrew, if you indulge me just for a second, is that all right? I'm not hearing yes. Just a point of clarification, Gary. Did I understand you to say that the $34, $5, $6, $7 million level of real estate transaction tax receipts, in your view, was unprecedented and not to be viewed in any sense as something that one should reasonably be expecting to persist over another, let's say, 9 to 11 months?
I actually said something a little different than that, and I don't want to belabor this, but what I said was the fact that those numbers had remained stable for 3 months during the course of this credit freeze suggested to me, and I'm suggesting to you, that that's what a frozen market looks like. Frozen market looks like, for example, last year at this time, I think February's proceeds were $105 million or something. They're in the sheet, and they dropped to $35 million. That's not a decline in real estate value. That's a decline in activity, right? The transactions aren't taking place. There's a very small portion of this is related to the general decline in value. So my point was, I think it would be hard to imagine what that kind of frozen market would look like for a year. But to Commissioner Page's point, it could happen, and this could be, a relatively modest part of what we would feel is our problem in the event that markets stayed frozen for 15, 18 months.
Yeah. I just wanted to make sure that we were taking that, if you will, positive caveat in a proper context, and you restated what I thought you said.
Okay, sorry.
I would say just maybe to throw a little bit more cold water on this, that while you characterize it as the frozen market syndrome, I think that it may not be unreasonable to say that the frozen market versus the economy elements of this could be functioning seriatim, and that what you saw for the last 3 months based on a frozen market may now translate into an economic freeze-up for the next X number of months, too. So that to say that it was unrealistic to assume that level could persist, I think we may need to confront a different reality going forward for the reasons I just stated.
Right, but a frozen market also implies pent-up demand when it unfreezes. So, there could be something good at the end of the road, too. So let's not get stuck. Let's see what let's see what happens, and then we'll go. I got to keep him quiet. Please, let's go on.
Gary, thank you very much. Gary, thank you. Gary, would you take us forward, please?
Moving into the MTA actions, the first is an information item, which is the February financial plan has been released. Each of the board members should have received it. This implements the board's actions in December for the adopted budget, and it also lists a calendarization of the 12-month plan for each of the individual items. Under action items on page 15 of your book, there is an action item for the TBTA surpluses. There are 5 discrete items there that are being requested of the board in this action item. And again, they're listed on page 15 of your book, and this does require a vote.
May we please have a motion, please? And a second, please? And a vote, please? So moved.
On page 31 of your books is the mortgage recording tax escalation payment to Dutchess, Orange, and Rockland counties. This also requires a vote.
A motion, please? And a second, please? Please, a second. And a vote, please. So done.
Moving to procurements for MTA wide, they begin on page 33 of your book. There are a total of 6 for $143,579,388. 5 of those are competitive, and 1 is a ratification.
And a second, please. And a vote, please.
There are no items for Metro North. Long Island Railroad has 3 procurements totaling $625,767.
Motion, please. Second, please. And a vote, please.
There are no items for Long Island Bus. There are no items for Bridges and Tunnels. New York City Transit has 5 non-competitive procurements and 3 competitive procurements, totaling $14,851,668.
Motion, please. Second, please. And a vote. So moved.
No items for MTA Bus. There is 1 action item for capital construction, and this is on page 55 of your books.
Motion, please. Second. And a vote, please. So done.
And there are no actions for First Mutual Transportation Assurance Company.
Okay, thank you very much. Please, a motion to adjourn. Second. And a vote, please. Meeting is adjourned.
CPAC will be right next. Nobody leave. We want to move right into CPAC.
Nobody? Oh, you're a tough taskmaster, Mr. Chairman. Boy, you don't fool around. Careful.